All right, welcome. Today, we're going to put on our detective hats. Seriously, because to really, truly understand a company, you can't just glance at the profits and losses. No, you have to dig deeper. You have to look for clues, and you got to uncover the story that's hiding behind all those numbers. This is your guide to becoming a financial detective. So let me ask you this. Do a company's numbers really tell the whole story? I mean, a company can have fantastic earnings for a quarter, maybe even a whole year. But does that really guarantee its success 10 years down the road? Not at all. The numbers, they give you a snapshot in time, but they don't show you the character, the strategy, or the hidden risks of a business. For that, well, we need a totally different set of tools.
Okay, let's dive into this. On one hand, you've got your quantitative analysis. That's all the math, right? The balance sheets, the income statements. It's absolutely crucial, don't get me wrong, but it's all about what's already happened. Then, on the other side, you've got qualitative analysis, and this is the investigation. This is all about the quality of the company's leadership, the strength of its brand, and its real ability to survive and thrive in the future. It's the story.
So our investigation has to start with the single most important clue: the people in charge. A company's success doesn't just hang on its product, it really truly hinges on the team that's making all the big decisions. Think about it. Every major decision flows from the top. The management team decides which new products to launch, how they're going to market them, and maybe most importantly, how to spend the company's money. Are they reinvesting profits to grow the business? Are they paying them out as dividends? Do they buy back stock? You see, good management makes good decisions, and that's what builds a great company over the long haul. So, how do we actually investigate them? Okay, first, check the annual reports. Has the core leadership team been there for a while? Stability is often a fantastic sign. A revolving door at the top can be a major red flag. Second, do a simple background check. Just Google the names of the CEO and the directors. Any fraud cases pop up? Any scandals? And third, check them out on LinkedIn. What's their background? Do they actually have a deep understanding of the industry they're in? The crucial point is, are they experienced and are they trustworthy? Okay, our next clue is buried in the company's past. Just like a person, every company has a track record, and any good detective knows you always have to examine that history to understand its character and, maybe predict how it's going to behave in the future. You can start by searching for the company's criminal record online. Look for terms like fraud or court case. But just as important is their history of capital allocation. Now, that's just a fancy way of asking, how have they used their money in the past? Did they wisely reinvest profits to grow the business, like Apple did when it was funding the original iPhone? Or did they just waste it on bad acquisitions and vanity projects? A company that uses its money well is a company run by smart people. It's as simple as that. All right, next up, we need to understand a company's defenses. Because in the brutal world of business, your competitors are always at the gates. So what is it that protects a great company from getting overrun? The answer is its competitive moat. The legendary investor Warren Buffett is the one who really made this idea famous. A competitive moat is just a durable advantage a business has that stops competitors from easily snatching away its market share and its profits. It's the structural defense system that keeps the castle safe. And this is the goal of our investigation. We aren't just looking for a good company, we are looking for a fortress. A business that is so well defended that it can withstand attacks for years, maybe even decades, and just keep on generating profits. So, what does a moat actually look like? Well, it could be the ability to produce something cheaper than anybody else. Let's take Suzuki in Pakistan. For over 30 years, its moat was built on low-cost, reliable cars and a massive service network that no competitor could even dream of matching. Other moats could be a powerful brand, a network effect where more users make the service better, or high costs that make it a huge pain for customers to switch to a competitor. That is a moat in action. But, and this is a huge but, here's the modern warning for our detective kit. No moat is guaranteed to last forever. The biggest threat today is often technological disruption. Just think about how streaming services like Netflix and YouTube made the moat of cable TV companies almost irrelevant, or how ride-sharing apps totally disrupted the taxi business. You always have to ask yourself, could some new technology make this company's castle obsolete? Okay, now for a really critical part of any investigation, looking for those subtle clues that something's not quite right. Great detectives notice the little details that everyone else misses. And in investing, these details are often buried deep in the financial reports. One of the most important areas to look into is something called related party transactions. This is basically any financial deal that a company makes with its owners, its top managers, or their relatives. Now, these aren't always illegal, but they demand your full attention because, well, they can be used to siphon money right out of the company.
Here's a classic red flag. You're digging through an annual report and you find that the company has given a huge loan to its main owner at 0% interest. Why is this a problem? Well, because that money belongs to all the shareholders and it should be used to grow the business, not to provide a free personal loan for an insider.
And here's another one to watch out for. The company acts as a guarantor for a massive personal loan taken out by its owner. This means if the owner can't pay back their personal debt, the company, and by extension all of its shareholders, is on the hook to pay it back. This puts the entire business at risk for one person's benefit. It's a massive, massive conflict of interest.
So, after gathering all the clues, you've investigated the management, you've checked the past, you've identified the defenses, and you've spotted the red flags. It's finally time to reach a verdict. You've now moved way beyond the simple numbers and built a complete profile of the company. So here it is, your toolkit, all summarized. First, vet the management team. Are they skilled and honest? Second, check the company's history for any scandals and for smart use of its money. Third, identify its competitive moat. How does it defend itself? Fourth, hunt for those red flags like related party transactions. And finally, assess the future risks, especially from technology. This is the qualitative checklist for any investment you make. You know, the numbers on a balance sheet can be crunched by a computer, but the real work, the detective work of understanding a business's quality and its character, that's all up to you. You now have the fundamental tools to start your own investigation. So the only question left is, where are you going to begin?